Hi everyone, good morning. Thank you for coming to our breakfast seminar. Before I start my talk, I would like to ask you all a question. Do you know what is the most powerful machine in the world that you will never break down? The answer is our Mother Earth. She's like a perpetual motion machine. She never stops spinning even for 1 second. Do you know how much worth of economy was created in year 2017? Do you know how much is these figures? It is a whopping $80 trillion. 6300. What does these figures mean? I'm not asking you to buy 4D, but this number is actually the number of new millionaires created in every single day. This is the world GDP chart since 1960 until 2017. Our world economy has been growing at the rate of 7.4% per annum. You can see that it's almost like a one-way uptrend. And here you see that we have a world GDP chart with S&P 500 chart from the year 1960 till 2017. The standard deviation or the fluctuation of standard S&P 500 is at about 16%, whereas our world GDP chart, the standard deviation is about 6%. You can see that the volatility for the stock market is rather high compared to our world economy. But however, they have a very high correlation coefficient, which means they are highly correlated to each other. And in the long run, they should track each other. Economy means business, and business means profit. And profits will goes into shareholders. As a shareholder, you'll be able to share the profit from businesses that you invest in. And what contributes to economic growth is our population growth, inflation effect, and technological advancement, and something that our government likes to talk about, increased productivity. So what's the secret to be the next millionaire? I know many of you are already a millionaire. How about to be the next multi-millionaire? Let me show you how we do it in Aggregate to grow money. Price to book ratio. I think you are very familiar with this ratio. What does 0.5 times price to book ratio means? This is a $50 note. Would any one of you want to change this $50 notes with me with $100? I think I must be crazy to ask you about this, right? Don't you think so? But actually every day when we look at stock market, there are a lot of such deals in the stock market. But why there might be this kind of good deal in the stock market? It could be businesses looks not sexy, they are not popular, they are outdated, or just people don't believe into the future that the stock will turn out well. That's why such deal existed in the stock market. We run a test. We want to see whether price to book ratio will be the good predictor for the future returns in next 1 year. From the table, from the chart, you can see that the black line is price to book ratio for Hong Kong Stock Exchange. And the yellow line is a next year forward return. You can see that when the price to book ratio is high, the next year return will be low. Or when the price to book ratio is low, the next 1 year return will be high. Apart from looking at Hong Kong Stock Exchange, we also look at other various markets in the region. This is Korea Stock Exchange. You also will see similar pattern when if you look at the price to book ratio is high, the next 1 year return will be low, vice versa. And how about our home country in Singapore? Does it have a similar effect? as well. This is Singapore Stock Exchange that we look at as well. Also the same, it will give you a similar predictive power. From here, you can see that just the price to book ratio alone is quite consistent in predicting the next 1 year future return. How about the popular other fundamental ratio like price to earning ratio? They also have a very high predictive future return as well. But however, we have to be very careful about using price to earning ratio to measure certain industry like cyclical industry. We look at the data in metal and mining industry. On your left is price to book ratio versus the next 1 year future return. And on your right is a price to earning ratio versus the next year forward return. You can see that from the right hand side chart, the PE ratio tend to run more wildly than the price to book ratio. It could be because of businesses, sometimes they might be making losses or they are making very little profit, such that the PE ratio will fluctuate a lot. Other than the metal and mining industry, we also look at electrical equipment industry. Again, you will see that PE ratio will run more wildly as compared to price to book ratio. Of course, other than price to book ratio and price to earning ratio, if one use price to cash flow ratio or dividend yield, they are also a good fundamental factor that can predict the future stock return. Many of our investors ask us why we are not investing in growth stocks. The glamorous one, the sexy one, or those the one that can even change the world. Let us explore. What is value stocks? Value stocks is what you pay for less than it's worth. And for growth stocks, you are paying more than what it is worth today, but you expect it to grow tremendously in the future. This is the secret. Please keep it to yourself. We run a back test. We are looking at the data of Asia Pacific stocks from the year of 1989 to the end of 2018, total of 30 years. We created two hypothetical portfolios. One will be in value portfolio. The criteria that we use to run the hypothetical test will be price to book ratio of less than 0.8 times, and we like the company to be in low debt so that they are less stressful. Net debt over equity ratio of less than 0.2 times. Whereas in the growth portfolio, you have those companies that the revenue for last 1 year was growing at the rate of more than 30%. And the net income of last 1 year growing at the rate of more than 5%. Every year, we run the same criteria again and again, which means we rebalance the portfolio every year. Let's see what happened to this value and growth portfolio for the last 30 years. You can see that the value portfolio is growing at the rate of 19% per annum. For $1, it will have grown to about $190. Whereas for the growth portfolio, it will grow at the rate of 15% per annum. $1 will have grown to about $80. A huge difference by a huge margin of 11,000%. How about the last 20 years? Would that show similar result? Again, you can see that the value portfolio will outgrow the growth portfolio by a huge 3,000% margin. And in the last 10 years, again, value portfolio will beat the growth portfolio by a huge margin of 180%. In 2017, growth stock did pretty well and it beats value portfolio, beat value stocks. Let's go back to the last 30 years and see what happened. In the last 30 years, in our hypothetical test, you can see that growth portfolio will beat the value portfolio on a year-by-year basis 14 times out of 30 times, almost half of the time. In a single year basis, growth portfolio will turn in a better performance than a value portfolio. However, if you stay on and invest in the growth value portfolio, you have gotten a far better result and return than the growth portfolio. Of course, if you do a stock picking and if you choose correctly, you may pick up Amazon, Alibaba, or Apple shares, and you'll be rewarded handsomely. Apart from valuation factors, we also look at the size effects of a company and to determine whether size effect contribute to the future performance. Again, we run another hypothetical test for the same 30 years, from the year of 1989 to end 2018. For the same pool of stocks, Asia Pacific stocks. But this time round, we'll create two different sets of portfolio. One called the small cap portfolio, which consists of those stocks where their market size are $30 million up to $200 million. And in the big cap portfolio, you will see those stocks that their market size are more than $200 million. Again, we will rebalance both portfolio every year with the same criteria at the start of the year. Let's see what happened in the last 30 years. The top part is the performance for small cap stock. You can see that the small cap stock portfolio will grow at the rate of about 8.6%. And the big cap portfolio will only grow at slightly more than 4% per annum. You can see that there's a huge margin created by the small cap portfolio. So it is not always the bigger, the better. Why is it small cap stock generally tend to do better than the big cap stocks? It could be because they have lesser institutional investors with them, or it could be they are less popular, such that there are no analysts wanted to cover them and write story about them. Also, they may be having a higher growth potential than the bigger companies. But why is it generally people tend to stay away from small cap stocks or even stocks at all? It is perhaps due to mental perspective. It could be people are afraid to lose money, so that they don't want to invest in the small, relatively unknown companies. Or because every day when we read the news, there are more bad news coming out than the good news. So we are afraid to invest. Our lives revolve around probability, especially in the stock market. So, what will be your odds of picking Amazon? There are about 108,000 stocks traded worldwide. So the chances of picking the next Amazon will be 1 in 108,000. The probability of 0.004%, not even 1%. But if you choose correctly, this is what will happen to Amazon. This is the Amazon historical share price from 1997 till now. If you happen to hold this stock, Amazon, in 1997, $1 would have grown to about 1,600 today, an increase in 1,600 fold. You ask yourself, how many would hold the stocks for more than 20 years? Most of the investors would generally hold stock less than 3 years, 2 years, or even less than 6 months. How many of us would really able to hold on the stocks and get rewarded? If you look at year 1999, at the peak of the dot-com boom, and until year 2000, there's a dot-com bust, you will also suffer great loss. And before 2004, Amazon not even turning in any profit at all. How many of you would like to invest in a stock where they don't even make profit? Of course, if you choose wrongly, this is Nokia past share price chart. Our handphone giant, once the handphone giant. During the dot-com boom, the share price went as high as $60. And today, it is hovering around $5 and acquired by Microsoft. You take a look at the black lines. It tells you about the PE ratio of Nokia. In 1999, during the dot-com boom, it went as high as 120 times PE ratio, which means at that time, if you were to buy Nokia, you have to wait 120 years to recoup your investment. Probability. What is the probability of winning Toto? The highest prize ever won in Singapore is slightly less than 10 million Sing dollars. So what is the odds of winning Toto? The odds of winning Toto is 1 in 14 million times. Every bet is $1, but your expected value is only 0.7, which means you will lose money by buying Toto. It is a sure loss. So, now take a look at the stock market in the short run, the probability for stock market. This is S&P 500 monthly performances from the year as early as 1871 until the most recent time, February 2019. The upper part, the green color that you may see, is an up month. The red color indicates of down month. Do you see any patterns here? I don't see any of the patterns here. The probability of up months for the last over 100 odd years, the up month is only about 57%. The down month is 43%. This is monthly data. But now, we look at yearly data, S&P performances, yearly performances. You see more green lines than the red lines. You see any patterns here? I can see something here. Now, we increase the horizon, assuming you have the luxury of time to invest in stock market. Assuming now you invest for any 10 years period. From the beginning of 1936 until recently, one bar means that, let's say if you take the year of 1996, which means you started investing in 1987 for 10 years. What is the rolling return that you can see? You see more green lines than the red lines. You hardly lose money if you have a 10 years investment horizon. 100% you make money lies in the waiting. Not just we say this, even the father of value investing, Benjamin Graham, the legendary investor Warren Buffett also say this. But especially I want to highlight to you is that data speak for this. I'd like to take a quote from Charlie Munger. He's the vice chairman of Berkshire Hathaway. He's a sidekick to Warren Buffett. He says, waiting help you as an investor. And a lot of people just can't stand to wait. If you didn't get the deferred gratification gene, you have got to work very, very hard to overcome that. What does this deferred gratification gene means? You know marshmallow? My children like marshmallow. I like to play games with them. I want to tell them this. You can have one marshmallow now, or if you can just wait for 10 minutes, just a short 10 minutes, I will give you 2 marshmallows. And you know what? Most of the kids will just can't wait. And would they straight away just grab the marshmallow and pop into their mouth and just eat it? Of course, they will ask for more later on, right? But if you could have just waited for another 10 minutes, you could have doubled your marshmallow. This is what we call deferred gratification gene. So sometimes it is best to leave your money in the game and just wait. The lessons here are twofold. Number one, it pays to wait. And you got to work very hard to wait. And as Warren Buffett said, no matter how great your talent of efforts, some things take time. You just can't produce a baby in 1 month by getting 9 women pregnant. I'm a proud father of 5 lovely kids. I know it best. There's this famous Chinese story. These farmers, he thinks that every day by pulling the rice seedling, the plant will grow faster. But as you may know, the more he pull it, the faster the plant dies. And this is what happened. As human beings, we are very interesting. And we always love to do something, some funny thing, such as hiding your cash in biscuit tin. I can tell you, cash is not king. If we invest in assets that can generate cash flow for us, that's the way to go. People always like to look at the stock market. They always ask, what's the outlook? What's the forecast? They try to time the market. And here, you can see that Morningstar, they did a research on timing the market. And what's the price to time the market? They look at the data from year 2007 to 2018. 2007 is a year before the global financial crisis. Now, they assume if you have 1 million to invest, you invest in the stock market. Of course, as we all know, 2008 and 2009 was the market crash. You see your 1 million came crashing down to about 500K in 2009. But it's okay. You tell yourself, no problem. Thing will pass. I shall continue and move on. As market recovers, your portfolio will recover as well. Your original $1 million investment will have grown to $2.4 million. And do you know what? After the market crash, another investor, he feel panic. He will tell himself, maybe we should just sell the investment, hold the cash, waited a bit longer. When the stock market turn around, we find a good signal, then we go back in again. So if he choose to do that, he delay his investment by 1 year. Upon the recovery, his portfolio will only grow back to $1.6 million. There's a huge difference of $800,000 if you choose to hold on and do nothing about your investment. Roller coaster. Tell me, how many of you find this roller coaster ride in stock market familiar with you? When you hear good news about a company or from your brokers, hey, this company A is turning in a very good profit result, I think you should buy it. Okay, good, I'll buy some of it. And true enough, later on, the share price went up because of a good news, right? Okay, now you tell yourself, maybe the stock has a good run already, I should sell it and take some profit off the table. Why not? So here you go, you sell your stocks. But then, there continue good news to come out from the company, the stock that you owned before. Now, on the fear that you're losing out the future gain, you started to buy this stock again. Then, here come a healthy market correction. The stock price came down a little bit. So you check with your brokers, you check with your friends. They tell you, no worry, they are still okay, they are still good. Since the price are cheaper now, okay, why don't I buy some more? I average down my cost. So you buy some more. After you buy some more, who knows, the bad news came out from the company and the share price tanked. Okay, now your good friend, your brokers will tell you, please, hold on to your investment. Don't worry, they will recover. But when the disaster strike, the share price went down, you start to panic. You sell the stocks. This is where investors pay the most for the cost of investing in stocks. The cycle will repeat itself. This is our human brain. We are gifted with a wonderful mind. But at the same time, as human beings, we are flawed as well. This tells you we have about 200, up to 200 biases with our brain. And we always like to do something. We have the need and the urge to do something. But if you choose not to do anything, you just look at the top one, the blue lines. By the way, this is the real return indices for stocks, bonds, gold, and cash from the year 1802 until December 2017. This is presented in the real terms, which means the results are already net of inflation. So if you look at the top part, the blue lines, if you were to invest in stock market since 1802, your $1 would have grown to close to $1.4 million. It grew many folds. How about bonds? If you invest in bonds for the same period of time, your $1 will have grown to $1,600. And people like to buy gold. During the wartime, or maybe trade war, people say you should diversify your investment. Maybe we should buy some gold. If you were to invest in gold, the $1 will have grown to $3. Gold is our best friend just to keep up with inflation. The long-term real return for gold is only 0.5%. Now, we look at the worst case. What if you hold cash? You do nothing and you just hold cash. Your $1 from 1802 until 2017, your $1 will only become 5 cents in the real term. You are losing money by holding money. So, remember I told you all about the waiting? This is what happened if you wait for 20 years. This is the S&P 500 performances with a 20 years investment horizon. One bar means that it's a performance of a 20 years performance. Do you see any patterns here? Do you see any red lines? No? Which means you will never lose money if you have a long investment horizon. They are all green lines, which means you will make money in the long run. So remember the probability we talked about earlier on. We look at S&P data again from the year of 1928, prior to the Great Depression. We look at the quarterly performance. Let's say if you have a short investment horizon, 3 months, quarterly basis. You have a 40% chance that you may lose money if you only invest in a short time frame. But if you're able to increase your investment horizon, you have close to 100% chance of not losing money, and you will be able to clock a long-term return of 10% per annum. This is the chart of S&P 500 from 1975 until 2018. And we also put in the data of a Singapore Property Index and gold. The green line is S&P 500. The black line is Property Index, Singapore Property Index. The orange line is gold. So it's very clear to you that equities will outrun even properties in the long run. Now, I think you know the secret of making money. As of the end of the talk, 5 billion worth of economy already been created. I wish you to become the next millionaire or the next multi-millionaire or to retire comfortably. And thank you very much. And I wish you to have a great weekend.